This is Jeremy Gresham, a principal of Scaffold Partners, and today's webinar is on self-storage. I've invited Stuart Page, the managing principal of Cainsville Capital. Hello, Stuart.
Good morning, Jeremy.
Morning. Cainsville Capital's managing principals have a combined 35 years experience in commercial real estate. They focus on multifamily, industrial, and self-storage, and they own 7 self-storage properties in Texas, which equates to about 2,400 units. For purposes of our call today, we're going to be discussing 10 topics we'll be touching on. What is self-storage? Why invest in self-storage versus other real estate assets? What makes a good acquisition target? How to find deals, financing, due diligence, operations, finding tenants, technology, and then concluding with value add versus new properties. So Stuart, why don't you kick us off with what is self-storage?
So self-storage is a space for individuals to rent, store personal as well as business belongings. The storage space is a pretty rapidly growing space. It's about a $220 billion a year business. It's often overlooked, but it's something that's utilized by most people in good times and in bad, whether you're good times, you're buying a lot of stuff, you need a place to store it. In bad times, you're downsizing and you need a place to store it as well. So it's a pretty recession resilient asset class. And so we're really excited about it. And we've done pretty well so far. And so we look to continue to build the portfolio.
And what types of assets, when you speak about self-storage, what are you really speaking about? What types of self-storage are there?
So there's a couple of different buckets of self-storage. The industry as a whole is made up about 25% of large public REITs. The remaining 75% is made up of mom and pop ownership, kind of scattered throughout primary, secondary, and tertiary markets. And so that's typically what we're targeting. We're targeting those mom and pop operations where we can come in and provide day one operational improvements and increase the NOI pretty rapidly.
Great. And then you're also talking about climate control versus non-climate control?
Correct. Yeah. So facilities, a good balance for climate control versus non. You're looking for anywhere from 20 to 30% for climate control. The rest could be non-climate control. You also have components of outdoor covered and uncovered RV and boat parking. And so those are some additional storage spaces as well.
Great. So second topic, why invest in self-storage versus other real estate assets?
Yeah. So like I touched on previously, self-storage typically does well in good times and in bad. Again, in places like Texas, where the square foot per capita is much larger than it would be in other parts of the country, somewhere 12 to 15 per square foot per capita. Again, good times are bad. People are looking to place their stuff somewhere. They either buy too much and they need to get it out of their garage, or they're downsizing. Baby boomers is a great example of this, where they're looking to downsize and they need to move a lot of their stuff into storage so they can move into an apartment or a smaller home.
And how do you compare it to multifamily as investing in multifamily versus investing in self-storage?
Yeah, so self-storage has just had a natural slow climb, whereas multifamilies had pretty rapid swings down and up recently through appreciation. Storage has just steadily climbed at a slower clip, but it's done very well. The cash flow is very strong day one. The appreciation is starting to increase more in line with what you're seeing in multifamily, and that's due to cap rate compression across other asset types, which is piquing investors' interest to move over into self-storage, which is causing cap rates to compress. So.
Great. And then you and I've also talked about that there's more mom and pop operators in self-storage.
Correct. Yeah. So again, 75% of the entire industry is mom and pop. So where we've looked at that traditionally in multifamily, it's kind of gotten picked through. Whereas in self-storage, there's still a lot of opportunity out there. You have these owners who are one of one. They might have a family member working in the front office and paying an exorbitant salary. Those opportunities are still abundant within the self-storage asset class.
Right. And then there's no rent regulation. It's also easy to evict people, right? And it's generally an easier asset to operate.
Correct. Yeah. So the operational side of things is vastly different from multifamily, where you might have a couple of maintenance guys, 3 or 4 in the leasing office. For self-storage, These facilities are typically ran by one individual and in some cases even fully automated. So your overhead is drastically reduced and somewhere around 30 to 35% of operational expense ratio. So very easy to run, and the margins there are really nice just due to that effect. You don't have renters, there's not plumbing issues, things like that. They're pretty simple facilities, low maintenance. So that's a huge upside.
And then it's easy to evict and you have month-to-month rents, right?
Correct. Yeah. So the leases are month to month, and whereas multifamily, you might be looking to be in the mid 90s for occupancy to be kind of comfortable. In storage, you kind of want that to fluctuate through certain times of the year. Christmas is kind of a slower time, and then closer to summer, you want to have some vacancy because that's where you can really push the rents on new renters. And so, yeah, it fluctuates back and forth, but they're month to month, and so you can charge whatever the market rate is for that unit at that time. And usually, once you get someone in there, they're really unlikely to move due to a slight increase. And so the way that we like to look at it is on a nominal dollar basis. So for multifamily, if you were to find a property where rents were 10% below the rest of the market, you might kind of scratch your head and think that's a lot of money to then turn around and put on the renter. Whereas in storage, it's nominal dollars. So if they're paying $50 currently and you charge them 10% more on a nominal dollar basis, it's only $5. And so they're very unlikely to go rent a truck, waste their weekend and move across town, which is probably going to be right around the same price, if not more expensive. So on a nominal dollar basis, you can find self-storage facilities that might be 20 to even 30% below market rate, just due to mom and pop ownership, enjoying having it 100% leased and not raising rents ever. So those are typically the opportunities that we're going after.
Great. Let's move to our third topic. What makes a good acquisition target? What are you looking for?
Typically what we're looking for, we start with the market. We like to see within, 5-mile radius or within a population, we're looking for 30,000 plus. That's obviously not a hard and fast rule, but these are kind of, guide rails for us to look for. So 30,000 population, we're looking for an average medium income of 40,000 plus. We're looking for limited supply or low supply of self-storage. And then we move to the asset itself. So again, we're looking for independent owner operators who might have had 100% occupancy over the last 5 years and haven't increased rates. They have no website, so they're not really tracking what their competitors are doing. They'd rather feel comfortable having it full versus maybe be at 90% occupancy and raising rents $40 on a storage unit. So that's typically what we're targeting. In self-storage, there's a lot more of those opportunities currently than there is in assets such as multifamily. And so we feel like there's a limited window here for us to go in and capitalize on those deals.
Great. And what about number of units? Do you looking for a certain number of units or?
Less unit number versus square footage. So we're targeting 30,000 square foot or above. And that's similar to what you would do in sort of a multifamily where you're looking for a certain unit number where the economics make sense to hire a third party professional manager. And so 30,000 square foot, usually the economics make sense to have a third party on site. And then we're looking for a nice variety of unit sizes. So we don't want any heavy concentration on 5x5s and limited number on larger spaces. So we want a nice variety of unit sizes as well as climate control versus non.
Great. And then what about traffic patterns?
Traffic patterns. So we'd like to see at least 30,000 cars per day in a pocket. Again, there's no hard and fast here. You might have 20,000, but it's in a great pocket where there's a lot of residential and not a lot of storage supply around. And so you can, 90% of your renters are going to come within a 5-mile radius.
Right.
And so those can be very fruitful as well.
Great. And then there is some overlap a little bit with multifamily in terms of you looking for population growth and employment growth as well, right? Just good markets.
Correct.
Right.
Correct. Yeah. Unlike multifamily, where hyper supply markets might be the darling for multifamily, it can kind of go the other way and hurt you in storage, where these hyper supply markets or hyper growth markets might start attracting the REITs to come in and build right next door to you. And they're in a better position to kind of sit there vacant if they need to for several years. Whereas, for us, we're just looking for nice, steady growth. It doesn't need to be in a hyper growth market, but nice, steady growth and a lot of residential nearby. That's what we're targeting.
Let's move on to our fourth topic. How do you find deals?
Yeah, so we are pretty proactive in reaching out to these owners and markets that we want to be in, whether it be sending them flyers or emails, going by the property and talking to owners directly. We're also very active in the Texas Self Storage Association, as well as the national, and so we're active in those groups as well. And so those are a couple of avenues. We're also very active in the brokerage community, and so working hand in hand with brokers. Once you start building up a track record of being able to deliver, you start getting those early looks that everybody's looking for. So we get a lot of first looks at opportunities while brokers are working on the OMs. And so, so long as we can remain competitive and continue to buy deals, we'll continue to get those looks.
Terrific. Okay, our next topic, financing. Can you talk about a little bit about debt versus equity, and then get into sources, how you're sourcing your debt?
Sure. So for self-storage, under a certain size loan, you're typically going to be working with local or regional banks. That's typically who you're going to be going for on a storage facility called 10 million or below. Once you get into much larger loan sizes, there's other opportunities such as CMBS for the debt side of it. Typical debt for a storage facility might be 70 to 75% leverage. You might be able to get 1 to maybe 2 years VIO, depending on if it's a lease up or if it's a stabilized asset. And then what we typically like to do is do some sort of escrow of principal and interest in order to have the recourse burn off over a 3 to 6 month period after a certain DSCR threshold being met.
Great. And then next topic, due diligence. What kind of due diligence are you guys doing?
Yeah, so a lot like what we do in multifamily, we're going through the property, we're checking out the surrounding perimeter, the gates are working, they're functional, the drainage is a big one within storage. You can certainly get bit there. Any kind of flooding will go into tenant or renters' spaces and flood out their property. So we're definitely looking at the drainage, we're looking at the roofs, the security cameras, and then the gates. That's a big one. The doors functioning properly, things like that. Those are all things that we look for in a facility when we're checking it initially.
And you're doing your third-party reports also, right?
Correct. So we still have environmentals and everything else. They come out, they look at the property. From our side of it, we want to know that the office is located in a convenient location. The pin pad is on the right side when you come in to the facility and things like that, that the office is positioned well enough for us to bring in things like boxes, U-Haul trucks, et cetera, so we can pick up on that other income from renters.
Our next topic is operations. Can you speak to the personnel that you would typically have at a facility, or how you operate that?
Absolutely. So we typically have a third-party management company come in and operate these facilities for us, and they will have, again, usually one individual on site. Depending on where the facility is located, it can be fully automated. And in some cases, in more secondary markets, we like to have at least one staff member on site so that they can be that point of contact, upselling, whether it be a truck, a box, a lock, things like that. And storage, your storage renter manager is oftentimes your bartender, your priest, and your therapist all in one. And so having that person on site that can build that camaraderie with the renters, it goes a very long way into keeping tenants happy, and obviously the renter retention there. So.
And then you're in touch with the property management company, I take it, on a regular basis and getting reports and.
Correct. Yeah. So we're in constant communication with our properties managers, if not every other day, being on site and checking in, weekly. We're constantly communicating with them, looking at the market, competitors for pricing, things like that, and making sure that we're in line and exceeding our renters' expectations. So.
Great. And then what about maintenance? What are the typical things you're going to have to, I know you touched on this briefly before, what are the typical things you're going to have to deal with on the maintenance side?
Yeah, so maintenance side, it's pretty simple. It's a lot of just making sure that the lighting's working, that tenant or renters feel comfortable coming onto the property at nighttime, that all the light bulbs are replaced, security cameras are working, gates are functioning, and then even down to just making sure that the facility is kept tidy and neat, that they're picking up trash, things like that. At a facility, it's pretty simple to keep it clean, but just making sure that we are keeping a clean and safe space for the renters.
Right. And then you're focusing on roofs and painting and all the other general doors and stuff like that, right? General.
Correct. So the ongoing CapEx items, we're constantly checking, post storms and things like that, making sure that there's no leaks or anything, for the climate control units, that it's functioning properly, for the HVACs and things like that. So that's kind of standard upkeep items that are checked throughout the week, months, and years.
Terrific. Okay, let's move on to finding tenants. How do you go about finding tenants for self-storage?
Sure. So a lot of ways that the industry works right now is through sites like Sparefoot. This is another easy kind of low-hanging fruit that we look for on a potential acquisition target, is if a facility is utilizing any of these third-party services like Sparefoot, and if they're not, that's usually a great indication for us that we can kind of come in and take over and do that day one. So those places allow for renters to get online, to reserve a unit, and to be able to pay for that and do everything really online before even stepping foot on the property. And so that's where 90% of renters these days actually rent a unit, is online. And so if a facility is not doing that currently, they're usually not pricing the units in line with the market either. And so we look for that and be able to leverage, again, things like Sparefoot to bring in traffic. We do put up discounts and things like that on the upfront monument sign when it's appropriate. And so getting a tenant in for maybe $10 less for month one, we know that we're going to pick that back up when they renew month over month, and we'll have a long-term renter at that point.
And so then your website is typically automated for people to sign into, right? To sign up. And
correct.
And
correct. So yeah, another operational improvement that we like to implement ourselves that a lot of mom and pop storage owners do not do is getting people rolled over onto auto pay. A lot of these facilities are still taking cash, so their payments are coming in late. And so we like to come into a facility kind of day one and encourage tenants or renters to get over onto auto pay as quickly as possible. And so you relieve yourself from a lot of late payments and things like that by doing it.
Great. And then what about the monument sign? Are those a big deal for you anymore, or that the big signs off the highway and so on?
It can be. Again, 90% of the renters today are doing it online. So they're just Googling what's within a 5-mile radius. They're comparing prices on sites like Sparefoot and making a decision from that. But you still have quite a bit of drive-bys. And so having an electronic sign might be helpful to showcase any kind of discounts and things like that. But beyond that, we also have managers that will go out into the community, go to local businesses and pass out flyers and things. And so even that hand-to-hand interaction sometimes is helpful to drive traffic to the property through discounts and specials.
Terrific. And then let's move on to our second to last topic, technology. I know technology is a big deal today. What types of technology are you using in self-storage?
Yeah, so I've commented quite a bit on Sparefoot. That seems to be one of the more technology-driven platforms within our space. And so that allows you to go on and compare, contrast to other storage facilities within your area, to, again, the simplicity of making your online reservation and paying for everything up front. So when you show up to the facility, it might just be purchase a lock or whatever it may be. So we utilize that. We also use StoreEdge on our management side. That helps us to track what's happening at the facility on a month-to-month basis or weekly basis, and compare that to the rest of the market, make sure that we're staying in line with where we need to be on rents to drive occupancy, et cetera. So those are two big technology drivers that we use for online. And then we also have some of our facility smart locks and things like that that are being utilized.
Great. And then the gates and keyless entry and things like that sometimes?
Correct. Yeah. Those are, depending on the facility and where it's at, the keyless entry and things like that, but the punch pads and everything else, making sure that all that's, functioning properly. The gates is a big component. Tenants renters want to feel like their property is being protected. And so having cameras on site and the gates functioning and closed at all times is imperative.
Okay, our last topic, we're going to talk about value add versus new property. So a new property like a lease up, let's talk a little bit about that. And then we'll move into the value add piece.
Yeah, so there's some great opportunities in lease up, just like there is in multifamily. So targeting sort of smaller developers who depend on selling a new asset in order to move on to the next project. Those can be great assets to pick up. You can usually get those at a favorable price versus something that a REIT has put together and
Right.
They're going to want, maximum price over a smaller developer who really just needs to sell and move on. So those facilities, depending on if they're well located, they're well constructed, those can be great assets to pick up. Again, there's an opportunity cost to going out and doing it yourself. So cutting down on the 18 months of permitting and building versus getting into the property, getting it leased and cash flowing kind of very, very soon out of the gates, those can be very attractive opportunities.
Great. And then what about when you come on site for a value add property? So one that exists already, what are the types of things you're doing to add value?
Yeah. So again, it kind of goes back to the operational side of things. When you come into the office, what does the office setup look like? Is it welcoming? Is there packaging and other locks and things like that they're offering to renters? When you pull up to the gate, is the keypad on the right side. Too many times you'll pull up and you'll have to see that a renter will have to get out of their car and go to the opposite side just to punch in a keypad. So just things like that. And then when you get onto the property, how wide are the driveway spaces? Is it easy to get a truck down to your unit? If you're on a second story, is it easy to access through the elevator? So really just those kind of common sense items of what's a renter going to experience when they're coming on the property. It goes a long way to keeping renters happy and wanting to renew.
What about things that you're going to be doing on site to add value in addition, like new things you're doing?
So we like to find facilities who are not offering things like U-Haul trucking. They're not offering on-site packaging, locks, and things like that. Those are really easy upsells to renters a lot of times that are just being overlooked.
Sure.
We like to make sure that we're offering the ability to do auto pay. We're offering things like move-in specials if we need to get a renter in and to onboard them for a full-time, hopefully renter. We're making sure that we have cameras on site. If there's not cameras, we're installing those. We like to make sure there's ample lighting. And then we offer things like covered parking for RVs and boats.
Great. And then you also, we've talked about, some of the building that you might do, like when you come on site.
Yeah, so we always like to have upside if possible. So value add, a big thing in value add self-storage is additional land, where that might be pretty expensive and time consuming for multifamily. The construction process and storage can be a lot easier. So we like to find facilities that have additional land that come with it. We like to have the ability, if we have enough demand, once we run a feasibility analysis, to potentially construct additional units. And an easier way to do sometimes, if there's the demand for it, would to take that space and put out gravel and maybe even do open space or open air RV and boat parking. And so you can get additional value out of that land versus it just sitting vacant.
Right. And then you also told me sometimes you guys consider cell towers.
Yes. So cell towers is kind of been a new one for us. It's been fun to explore. There are companies out there that will come in and do a feasibility analysis on your property that they work with all the major carriers. And if it makes sense, the carrier will actually come out and erect a tower. They maintain it. They do everything kind of soup to nuts for you. And it's more of like a land lease. But those can be great kind of additional income drivers, as well as billboard companies. If there's the right space and you're near a major intersection or any kind of high traffic area, to bring in a billboard company, those can be great additional revenue drivers.
Terrific. Okay. I think we've covered our topics. Anything else you wanted to mention at this point, or?
I think that's it. I think, again, we're very bullish on self-storage right now. And we think there's a lot of groups that would agree with us, and there's a heavy push into the space. And so long as there's great markets with, facilities that are ran by mom and pops that are overlooking a lot of value, we'll continue to try to acquire those assets.
Thank you, Stuart. I've been speaking with Stuart Page, who is managing principal of Cainsville Capital. They own 2,400 self-storage units, 7 properties in Texas. If you have any questions about what we've discussed today, please reach out.